able to reduce costs.
Welcome to the Economic Times Sustainability Forum. This is a session organized for sustainable finance and how green finance can support India's goals to net zero. I would like to introduce the esteemed panel. Mr. Sheshagri Rao, Joint Managing Director and CFO of JSW Steel. We have Mr. Praveer Sinha, Managing Director and CEO of Tata Power. Kaku Nakhate, Country Head for Bank of America. We have Mr. Sunil Nair, Chief General Manager of RBI. We have Anirban Mukherjee, Partner and Managing Director at BCG. And we have PD Singh, Managing Director and Head of Corporate Banking, JP Morgan. Just to start the discussion off, India has committed to net zero. India is committed through Panch Amrit principles or Panch Amrit pathways. And they comprise reduction of emissions, increase in renewable energy, increase in clean energy usage, and also sort of enhances the Paris Agreement targets on emissions intensity. India's emissions primarily stem from the industries, power, and transport. And then we have the need for green finance to support this. That's the thematic of our discussion today. Can I start off with you, Mr. Rao? Steel is considered to be a hard-to-abate, carbon emissions are very hard-to-abate sectors. And in this trajectory, in this journey towards net zero, what is it that green finance and how is it that green finance could help the steel industry reach net zero or at least reduce emissions to a significant level?
Steel sector, as you rightly mentioned, is considered as hard to abate sectors. Why it is hard to abate? If we just look at it, the scope 1, scope 2, scope 3 emissions which are there today, there are scope 1 emissions which are very, very difficult with a cost-effective technologies that can replace the cooking coal or existing technology today. That is why it is called hard to abate sectors. But if I just see the International Energy Agency sustainable development scenarios in the next few years, they predict or they estimate that the emissions should be reduced, particularly in steel sector, by 60% by 2050. So if emissions are to be reduced to that extent, there is a huge investments that are required. One step cannot solve this problem. There are a series of steps in phases and different pathways to be followed by the steel sector to achieve this carbon neutrality as committed by India by 2070. So green finance will definitely help the industry to expedite and accelerate the investments in this segment and ensure that the carbon emissions are reduced. Energy intensity in steel production will also come down.
If I may now come to you, Mr. Praveer Sinha, how do you see power sector shifting itself out towards net zero, and what's the role of finance here in terms of what can green finance do and what needs to be defined as green finance for the power sector?
I think if we can really transform the power sector and move towards sustainable generation of electricity, not only it will mean more electricity that can be supplied, but also how it can support in the mobility space, which emits 20% of the CO2, and also in the industries, whether it is hard to abate industries or any other industry. And I think power sector transformation will, to that extent, be very, very important if it moves towards sustainable energy. When we look at what is the opportunity it is giving, and especially if we have to decarbonize and decentralize the generation, we can make each of the consumers dependent on their own generation. We have now consumers who can be industrial consumers, consumers who can be commercial consumers, residential consumers. They can all produce their own energy to a large extent, use it themselves, and they can also sell it back into the grid or sell it amongst the community over there. And that's the role change that we are seeing. So just from being a user of energy, they are now producer and a seller of energy and becoming a prosumer. And this is meaning that how do we create more and more empowerment to the local people? How do we support them? The whole financing arrangement that we have today needs to undergo a huge transformation if we really want to make this universal. So I think there is a great opportunity for power sector to transform. It requires support from the government, but it also requires support in the way the whole banking system is working for retail customers.
Now let me come to the finance side of it, Kaku, in terms of saying the quantum of money required for India's transformation, green transformation, or whatever we want to, net zero directing, and versus whatever the government has put up in terms of saying this is what much investments need to happen in green. In terms of tracking, the actual investments are far short of that. Globally, it is the same situation. From a net zero point of view, from an NDC point of view, far lesser money flows. Bank of America being one of the largest banks globally, and in the space having joined G funds. And what we were discussing some time ago is the issue of global capital, green capital. It's not finding its way to India. Your thoughts on both domestic and international institutional finance, how does it come to green?
To answer your question, actually, we have to do a lot more to be able to attract finance into India per se. Globally, I think most of the financing, as we are all aware, have gone into sustainability linked or ESG linked bonds, if I may say. Blended finance has been another such vehicle really to go for it. For this, I would say, if I were to just take emerging markets this year, around 10.5% bonds in emerging markets were actually ESG-linked bonds. But India actually contributed only to 0.7%. Right. If I look at China, it was 25, Korea was 20, even Malaysia was around 10% or so. So I agree with you, we have to do a lot more. One of the things is our bond markets are not yet opened up. So that's a separate and a wider issue. Right. Because to attract capital, we do need to open up bond markets and get them included in the indices. As a result, flow of capital actually growingly, goes on passive funds, whether it's capital, equity, or whether it's on the bond side. So that's a work in progress. I know everybody, including regulators, are looking at it closely. And that's one big way to, call in capital into the country. The other thing is on blended finance. The multilateral agencies are willing to put in initial, funds for newer kind of technology, the cleaner technology, the technologies which probably have not seen the light of the day. And that's when banks can come in with slightly costlier capital, and the blended finance would be much cheaper, which would make the projects viable. And one another thing that we can think of, and sir is next to me here, and I can appeal to him, that another way of doing it is, since we have not opened up the markets, we could also think of a green bank. We have seen countries like Japan, Australia, Malaysia, Switzerland, UK, all having green banks. The idea of the green bank is to seed and show the direction to the market as to what really qualifies as green.
From international capital to domestic capital, sir, what is it that the regulator can play a pivotal role in shifting more finance from both banking, NBFCs, and capital markets to green?
As you're aware, Reserve Bank of India became a member of Network for Greening of Financial System in April 23-21. And the Network for Greening of Financial System is a group of central banks which started off with 8 in number, and now they have 100 plus members who are part of that organization. Their role has been to guide the central banks and take them together, be it hosting training programs or be it coming out with consultation papers on various aspects like scenario analysis, stress testing, capacity building, and stuff like that. Now, if you have to look at Reserve Bank of India, I think we set up a sustainable finance group in the central bank a year back, and a lot of activity has been happening. The latest to happen was, as a part of credit policy, governor had announced that we'll come out with a discussion paper on sustainable climate risk and sustainable finance. That's already there on the website on July 27, 2022. We have uploaded that, and we are given 2 months' time for the various stakeholders and the regulated entities to comment on that. Along with that discussion paper, we have also posted on the website a survey which we had conducted covering 34 banks, which included public sector banks, private sector banks, and foreign banks. The intent of that survey was to get a flavor of what is that the regulated entities are thinking in terms of climate risk and sustainable finance. It has given some interesting insights as to what the banks are thinking about. This, coupled with the discussion paper, I think will set the tone going forward as to how climate risk and sustainable finance can be taken forward. Having said so, Reserve Bank has been doing a little small kind of things. I think priority sector lending is a classic example, where we have been permitting banks to lend to rooftop solar or renewable energy and stuff like that. But it doesn't stop there, because the amount of finance required for climate risk and sustainable finance especially is huge. So we are wanting these stakeholders or the regulated entities to respond on the discussion paper, because the discussion paper covers 4 basic aspects. One is about the strategy, second is about the governance, third is about the risk management, and fourth is about stress testing and scenario analysis. Of course, disclosure is one part of the particular discussion paper. So it has to flow from top. So for a regulated entity, that governance structure has to be in place, there has to be a strategy in place, there has to be a sense that they are capturing that particular risk when they are trying to lend or invest. So we want the stakeholders to respond to the DP which we have come out with.
Anirban, request you to throw some light on green finance or cost of green finance, if that can be explained a bit in the sense of what role it can play, and in trying to link it to what Kaku said on blended finance.
I think the need for green finance has been very well articulated across sectors, especially the hard-to-abate sectors. And just to put some numbers into it, to meet our climate ambitions of net zero, even the NDCs till 2030, we require close to about $200 billion annually in green investment, of which at this point in time, we are far short. We are maybe in the tune of 20 odd billion, which is about 10% of what we need. And even within that, large part of that is still public and domestic sources. So the need to deepen the green financing and tap into international funds is really stark and really immediate. Specifically in terms of the blended finance is possibly one area which we do need to tap into, but let me qualify that blended finance essentially is bringing in concessional capital either from public finances or philanthropic sources to be able to invest into projects or programs which on their own may not have the scale or may not have the commercial viability to attract institutional or private capital. The idea is not new. Even in India, we've had blended capital. However, in the context of climate financing, the context is possibly a little bit more complex. Why climate becomes a little interesting is because here we have a problem amongst possibly all axes. We have unproven technologies, we have new markets, and often we have problems of scale all built together. And therefore, there is a need to look at blended financing in terms of bringing different investment themes together. Also, I would say we should not forget the multiplying effect that if we are able to do this right, for every dollar of concessional capital that gets pulled into blended finance, there is a $4 additional dollar that it is able to pull in from traditional financing. So in some way, the path for us as we traverse this large journey and looking at the deficit that we have in terms of what we have and what we need, blended finance is very, very important. And the role then spans across the group, the representative group that is sitting here.
Now coming to Mr. Praveer Singh, as an overall banking ecosystem, what needs to be done? What is the international experience that we probably need to get that right in India? Your thoughts, please.
In the international arena, we have seen a whole lot of initiatives. Just to break that down a little bit, to go into certain things. For example, JP Morgan has a carbon compass framework, which we put into place probably in May of last year. So we've chosen 3 sectors to begin with, for example. So that is electric generation, automobile manufacturing, and oil and gas. 2 more sectors will be added as we go along in this journey in this year. So the sector-wise deployment, making sure that legacy businesses, as they readjust, we are also able to make sure that the asset managers are reallocating the assets in the right manner. JP Morgan has committed 2.9 trillion, aims to finance or facilitate 2.9 trillion up to the end of 2030. This is for carbon intensity, climate change, as well as sustainable development. So if I just break it down into green financing or carbon related activities, it is $1 trillion up to 2030. It's a very large number. And when we look at it again, breaking it down into year-wise ambitions, we are at 106 billion in just 2021.
Mr. Rao, what would you like green finance to look like for the steel sector?
As I mentioned, in the steel sector, there is no one single solution. It is a combination of actions that would reduce carbon emissions over a period of time until the new technologies will become affordable for the industry. So during this time, when India is considered a developing economy, steel consumption or any of the other hard to abate sectors continue to grow. So we have to create capacities for India. So personally, as JSW Steel, we went and raised sustainability-linked bonds in the international markets. So when we wanted to raise that money, then it has to be certified that the commitments which we are making for the future are ambitious enough. Ambitious enough with reference to what? When you are sitting in a developing economy like India, where we are far behind relative to the companies located in other countries, then if we have to have ambitious targets without any allowance for India, then there is a problem. Then the amount of investment which we have to make is large. That is not subsidized either in terms of interest cost or in terms of tenor or in terms of any other benefit which can come into Indian companies. Indian consumer is not willing to pay extra because you are producing something by investing here. In the long term, yes, it is beneficial. But as on date, if companies have to continue towards carbon emission reduction and make more investments, I think we should have our own rules and regulations which will qualify for the green finance, all the efforts that are being done towards reduction of carbon emissions. That will enable to raise money, either in the local market or in the international markets.
In the power sector, I think the transition that India has embarked on and saying that we will have a thermal power transition, which often leads to an understanding that there is a transition which may entail some coal power plants to become gradually phased out, because that was the term which was used in the last COP. Is there a green finance requirement to transition out coal power plants? What's your view like in terms of what you think is expected over here?
We have many plants. We have very old plants, 20 years, 30 years, 35 years, 40 years. And if they have to move out and you create space for the green energy, then what happens to those plants in terms of how do you take care of the book value of the plant and who funds that? And I think these are the 3 core areas I feel that if we have to speed up, and India has a very ambitious target, 2030 we want to do 500 gigawatt We are already only at 160 gigawatts. So the speed at which we need to implement in next 8.5 years is phenomenal. We've never done that in last 10 years, 20 years. So if we have to enhance the speed, the financing arrangement also has to keep pace with the type of arrangements that we have. And I think that's where we are looking at the support, whether it is the regulatory support or it is the actual financing arrangements through various models that has to be put in place.
This brings me to Kaku in terms of a very specific question here. We heard innovative technologies, we heard financing arrangements, we heard need for new structures, but banking remains an old game where the banks will finance what has been done in history. So how does the banking sector move with the speed that Praveer is asking for and adapt to the new technologies that Mr. Rao is talking of? What needs to change for the banking sector?
Bank of America has been playing a leading role.
Yeah.
And Brian actually has been chairing the ESG metrics world over. So we are already at 351 billion. We have to take bets for that, how we recognize NPAs. If it's wind energy, there could be times when the wind is not there. So how do you really account for? The project financing will have to undergo change. We at the bank are looking at data all the time for plans that we are financing, and then rediscovering decision-making matrix, which will be different and has to be science-led. So a lot of things have to get married in a new fashion to really reinvent.
Mr. Nair, let me just move on to you with innovative finance, new technology finance. Is there anything that the central bank and the regulator can support here?
There is a need to create a framework for the money to flow in. Let us not stop at saying that it's only the banks who are doing it. Do we have a framework in place which will attract money to India? So what are the basic requirements here? Is there a tick box kind of thing? Can we create some kind of the basic requirements that you should have a taxonomy, you should have a disclosure framework, you should have X kind of thing? If all those things are there, the money flows in. Otherwise, if individually each of the entities is trying to run after things, it's not going to take us anywhere.
What needs to be done in terms of hearing the need for financing mechanisms and structures? So any thoughts on how such scale of investments, we spoke about international money, domestic intermediation needs to happen. And this green finance, there is also an underlying thinking around blended finance. I need to reduce the cost of finance. So any thoughts on putting this, joining the dots together?
As we look at this problem, we are going to be dealing with significant amount of uncertainty in terms of technology scale, which one comes at what point in time. However, businesses can operate, or banks and lenders can operate when there is a predictability of action even amongst this uncertainty. Therefore, as we look at the India's transition path, and there is an element of, if I look at globally, about 85% of emissions is covered in terms of countries which have taken targets. 65% have taken net zero targets, but not yet gone ahead into the transition roadmap, sectoral roadmap. India is amongst them. There is about 15-20% countries in terms of emission who have gone ahead and developed their sectoral transition roadmap. And that is important because eventually we will have to deal with increasing electricity consumption or usage, decreasing fossil fuels, increasing penetration of low carbon fuel, acting more on energy efficiency and demand management, and then looking at carbon capture and carbon storage technologies. The question is at what happens at what point? And that is where the trade-offs come in terms of the cost, in terms of the impact. India is one of the largest contributors to carbon markets, but we have not yet been able to participate in the carbon markets on the back of the nature-based solutions and the energy efficiency initiatives, the biofuel investments that we're making that still qualify, but we still require the taxonomy for us to be able to organize ourselves, create the right validation systems around it, and use that to bring in capital to then have a more predictable path to the energy transition that we are looking into.
Coming to you, Mr. P.D. Singh, few lessons that could be learned, and given the commitments that JP Morgan has made in its targets, in joining GFANs, all of the commitments put together, what lessons do we draw for the Indian banking system?
So I think we have to listen to our customers, split the problem into smaller, bite-sized issues like this that we can resolve industry by industry and problem by problem. So that is a small learning from that I have come across.
Let me just thank you all for this illuminating participation that we have had. Thank you all.